I think what we see in Asia is a lot of structural alpha opportunities, meaning that the markets here are quite inefficient in many ways, more inefficient, I would say, than the markets that you see in the developed markets of the US and Europe. So in order to capture that alpha, which is an opportunity, but it's complicated. So in order to capture that alpha, you really need to be on the ground and have a local presence. And I think one of the sort of the industrial logic behind the combination of Baring Private Equity and EQT was that we had built in Asia over the last 3 decades a capability to invest across the region with local teams everywhere from Japan to India to Southeast Asia all the way to Australia with that local capability, and are able to originate, create value, find talent, and then drive exits in these markets. But it is extremely important to be local. I think doing it in Asia is complex, and the entry barriers, I would say, are relatively high to be able to do it consistently and to be able to do it at scale.
And John, just to follow up on that complexity that you are talking about here, China is a complex market for really many people for many different reasons. I understand that it's not one of your priority markets in your strategy just yet. Is that changing in any way? What do you need to see in that market to have a more meaningful presence?
Well, we have 350 people across the region in all the different markets that we operate in, including in China. We continue to stay active in China. I would say that from our perspective, we have different strategies. We have a large cap buyout fund, we have a mid cap buyout fund, and we have an early stage strategy on the private equity side. If you look at those different strategies, the buyout strategy, we believe it's a little early still for buyout investments. The maturity of the market is not quite there yet in China. But where we see a lot more interesting opportunities in China is in the early stage strategies, where there's a tremendous amount of innovation, there's a tremendous amount of growth. And I'm actually pretty positive on the outlook for China. I've been there the last 2 months. I've been there 4 times, actually, different cities in China. And what I'm seeing on the ground is a tremendous amount of innovation and a pretty dynamic economy with a lot of interesting earlier stage, more growth-like investment opportunities.
And how do you think about sort of steering away from this whole U.S. and China dynamic, a pretty difficult relationship, and so much of this region is exposed to that tensions between the U.S. and China. Do you think about some difficult scenarios? Do you brace for, in worst case scenario, stranded assets or some kind of forced divestiture or premature kind of exit from some of your positions because of that?
No, we don't really see it that way. I think the way that we look at the world, we're a European headquartered, Nordic rooted firm. Our heritage is really in Sweden, and we've grown the business from Europe to now becoming a global business. We take a pretty neutral perspective when we think about the world. We have a very global outlook. We have operations in the United States, very active in the US. We have a strong presence in Europe, and we have a very strong presence in Asia. What we're trying to offer our clients is a diversified global investment program across infrastructure, real estate, and private equity. And when we think specifically about what's happening now in Asia between the United States and China, say, your question, our investment strategy is very much grounded in the domestic story of domestic consumption growth, domestic demand. So if you look at our portfolio, it's mainly services companies, software companies, education companies, financial services companies. And these are businesses that are very much tied to what's happening in the local market. For example, take healthcare, which is one of our biggest markets. In India, we own one of the largest hospital groups in India doing gastrointestinal procedures. That business is booming, and it's really completely uncorrelated to what's going on with trade or with trade tariffs and all of that complexity. So I think we try to stay insulated from that with a domestically focused strategy, which also ties us into the highest growth opportunities in the region, which tend to be more of the domestically driven growth thematics.
And Per, to zoom out and really look at the picture, big picture in the PE industry. In fact, one of your competitors, Joe Bay of KKR, was in Hong Kong in recent days, really making some interesting comments about how there are just so many PE funds in North America that he was actually talking about there are more PE funds than McDonald's in North America as well. To me, it sounded like industry consolidation is underway. Do you feel like EQT, because it's got scale, that it's at an advantage in an environment like this?
Yes, we also see that consolidation of the industry continuing. If anything, we think actually it will be accelerating. There's a number of forces driving that. We've already touched upon some of them. Institutional investors in particular wanting to consolidate their relationships to a number of core partnerships. Then you have the whole topic around AI and the need to really invest into your AI capabilities to be able to continue to deliver for investors. Then you have the democratization of the asset class, the private wealth opportunity, and then that desire from investors to achieve a better global diversification in their private markets portfolios. And all of those factors are really driving that consolidation. And post the merger between EQT and Barings private equity, we think we are really strategically exceptionally well positioned in this environment to continue to deliver for investors, for clients, and also to continue to actively participate in that ongoing consolidation of the industry.
Per, this is Martin. Let me quickly jump in. This is a question for you, but I'd also like to get Jean-Eric to weigh in as well afterwards. And this is, when you take it up to 30,000 feet, what's important for PE players like yourselves, obviously, is interest rates, right? The cost of money. It's been a pretty tough last couple of years, I think would be fair to say, for most people in PE. But now that we've had rates coming down is probably about as far as they are going to go in this cycle in most of the world, with the exception being, of course, the Fed, and some folks think there's another maybe 4 cuts to come. I want to get your sense whether this is going to mean a much easier environment for PE, including for yourself, in terms of not just raising funds, but also exits.
We certainly don't count on interest rates coming down further from these levels. So we think that it will continue to be very important that you continue to invest into your value creation capabilities, into your sourcing capabilities, to be able to create really attractive risk reward and outcomes for investors. Having said that, though, we also see that pickup in deal making that you referenced, Martin. We see IPO markets potentially opening up again, and that will give buyers also the confidence in the private markets to pay up for assets, and should lead to a further pickup in deal making, and also to pick up in levels of exits and in monetizations. At EQT, we've been quite active actually in the public equity capital markets over the last 1 or 2 years. I think we're the most active player globally, and that has enabled us to send significant cash back to our investors, 25 billion euros actually over the last 12 months. Yeah, we continue to be positive about the near to midterm outlook for us and for the industry to continue to drive monetizations.
All right, Jean-Eric, weigh in on this. As chairman, what do you think? Is the environment improving for PE?
Sure. Well, I would say that we at EQT don't really, our investment strategy is not highly correlated to the interest rate cycle, is what I would say. I think if you look at the way we invest, we're very thematic investors. So we're investing across multi-decade type growth trends, like I mentioned healthcare in India, or the growth of software moving to the cloud, and now with the AI functionality that's coming into software. These are long-term trends. If you look at some of the monetization events that Per just referred to, for example, Galderma in Europe was a $9 billion monetization this past year, while interest rates were very high and public markets were not that open. But for the right assets, we were able to monetize, I think it's the largest single private equity-backed monetization ever in Europe. We did the same thing with our very thematic investment in Asia in a company called Nord Anglia Education, which is the largest private education company in the world. That is a thematic, long-term, multi-decade trend. People want to invest more in their children's education, particularly in this part of the world. And that business, we delivered $10 billion of distributions back to our investors, again, through a very challenging environment in terms of where interest rates were, what had happened to multiples, what was going on with the exit environment generally. So I think if you have the right assets in the right sectors and you're adding value to the businesses, we try to create kind of an all-weather strategy that's not necessarily correlated to what's going on with interest rates. When interest rates come down, I think things do get more active. There's a lot more buoyancy in the markets. That can be good. That can also be bad. It can create more competition in the market because all boats are rising. And I think where we've found ourselves to be able to differentiate is in these more difficult markets where we literally had, I think, a record, our biggest year ever for exits this past year, returning something like close to 30% of the NAV of our funds back to our clients, which is high even for good times, let alone the difficult periods that we've been going through.
Yeah, I saw that. That's actually pretty amazing. So I hear you, Jean. Eric, it's not so much to do with interest rates. You invest more thematically. One theme that we haven't really talked about, we sort of skirted around the edges, but let's get to it. AI and how you're investing in AI, specifically China. You mentioned you're looking very closely at private companies which are very big on innovation. How are you thinking about investing in China AI privately when you are going to more likely than not have to team up with the government, whose incentives and goals may end up being very, very different from private investors?
Yeah, we're not really investing in AI directly as such in any companies in the technology layer per se. What we're trying to do globally actually is bring AI into all of our companies. So we just spent, actually a week, we took 100 of our portfolio company CEOs and chairmen to the US to see what's going on with the leading cutting edge AI companies there, and are trying to bring back that know-how, not so much in the technology stack per se, but more in the workflow and the processes and the automation that needs to happen. Because AI is going to affect not just the technology sector, it's affecting all services businesses, it's affecting the healthcare sector. And so what we're doing at EQT is we're putting this at the very top of our strategic agenda, both internally in the way that we run our business, and also within the portfolio companies, in the way our portfolio companies think about the leaderships in those businesses and how they implement all the technology that's available out there to improve their productivity and to drive innovation in their businesses. This is a huge fundamental change that's happening across all industries, and it's very much a focus for us at EQT.
Yeah, and Per, really for your strategy, I mean, at the top of the interview, I was talking about really this robust, rapid growth story for EQT in recent years. And then you are also pursuing a strategy of inorganic growth as well. And I believe you're really anticipating the next question coming. Can you give us any updates in terms of your discussions with some of these acquisition targets? You're going for scale, and what's really on your radar? I know that there are some names out there that are being floated. Any update on that progress?
M&A will continue to be an important part of our growth strategy, both in existing business lines and also to fill gaps that we have in the platform today. I'd say in our existing business lines, we probably see the biggest opportunity to grow through M&A in the US. And in terms of filling gaps in the platform, what we've said publicly is that we want to strengthen our capabilities in secondaries and in solutions. We see here a growing interest from our clients, from institutional investors, to engage with us to help them rebalance portfolios, manage liquidity, but also to help them stay invested in the right assets, in their winners for longer.
And John, the next question is really about secondaries. I mean, Per just mentioned secondaries as well. Some of the potential acquisition targets are really secondary focused companies as well. But how should we understand this really rising trend of secondaries? Isn't this a sign of some kind of pain in the industry, that assets are just moving from one balance sheet to another? And to add to that really quickly, John, that you say you focus on active ownership, but some of your recent exits have been secondaries as well. So do you see perhaps that kind of really active ownership and exits will get better in years to come? And how do you view secondary sales pickup at the moment?
Yeah, no, that's a great question, Chery. I think if you step back for a minute, our industry has something like $3 trillion of unrealized NAV sitting in people's portfolios. And if you look at the amount of secondary volume in the market, it's less than 200, it's about 150 billion or thereabouts out of the 3 trillion. So about 5% of the market trades. If you compare that to any other asset class, our asset class, it's very underdeveloped in terms of the liquidity in the system, which is actually a very healthy and natural part of any asset class to develop more liquidity for those owners of those assets. Whether that liquidity is coming from people exiting the companies on a primary basis, or whether that liquidity is coming from people being able to find solutions within the secondary market, it's all very complementary, and it leads to a healthier, more liquid, better fundamentals for the asset class long term. So we see the potential for the secondary market as being huge in terms of the runway going forward, just because it's actually meeting a client's needs that clients have for greater liquidity as this asset class becomes more mainstream. Historically, private equity was really kind of a niche strategy, so people were okay to have a small percentage and have it illiquid. But I think as it becomes a much bigger part of people's portfolios, it's going to need to be more liquid, and all these kinds of solutions that we're talking about here will be part of that.
Okay. All right, I hear you. Gentlemen, both of you, thank you so much. Excellent talking to you. Thank you for the time. Appreciate it.